I told you this day was going to be kind of rigorous. We're going to keep it coming at you, but you'll have lots of resources to take home. Let me throw out a question that I've been asking a few people individually. When I was at the Next Gen Summer Institute 2 weeks ago in Palo Alto, they had a few segments where we actually created things. In other words, we went into the Next Gen interactive library or looked at some of their videos, and we created our own lesson wrapped around their materials. I'm thinking about that as a segment for boot camp next year. Would you be interested in doing with that, where you would actually leave the boot camp with a lesson that you created, kind of tweaking? Okay. Then what we'll probably do is add that segment next year. Maybe drop one of the content chunks and add that. How about the teacher panel? Do you want to continue that next year? Different questions, perhaps? Yes. Okay, good. Good for the feedback. Thank you. Okay, so we're going to talk about some current trends. I did the research in the previous section. Now I'm just going to talk about what's happening out there in the world of personal finance so that you're giving your students the most current information. So this is pretty powerful. How many of you have a high deductible health insurance plan? Not too many. Okay, so people that work in the public sector are pretty insulated from the what's been happening in the world out there is these high deductible plans. And last year we hit a milestone in this country. In 2016, for the first time ever, we have more than half of American workers, 51% to be exact, that have a deductible of more than $1,000 on their health insurance. And that's just for a single person. That's not for a family. So we've got a lot of people who are paying big bucks out of pocket for their health insurance costs. So one of the activities that we're going to do a little bit later is to have you do some math to figure out what that out-of-pocket cost is. In 2017, they're estimating that by the end of this year, 84% of large employers will offer high deductible plans, and 35% of large employers will offer only high deductible plans. So the only choice that workers will have, if they have any choice at all, might be how high that deductible is. For example, in the state of New Jersey right now, and I don't know if any of you are in that state high deductible plan, they have two choices, $1,500 and $4,000 that you choose. Personally, I've looked at the math behind it, and I don't see the premium savings in relation to the amount that you would be on the hook for, but everybody makes up their own decisions. Okay, next thing that I found interesting is another trend that who knows what will change it in the future, is a study came out last year that said that the percentage of uninsured people in this country is at an all-time historic low. And they found that it was 8.8% of respondents versus 16% in 2010. So of course the Affordable Care Act has a lot to do with that. So that's 27.3 million people that now have health insurance. And remember, 10 years ago or so, we were talking about 44 million people in this country. So they obviously made a pretty big dent in that 44 million. You could see on the slide there, though, that the percentage of young people who are uninsured is much higher than the percentage of older people, you know, especially people who are getting close to that Medicare age, but, you know, people have more issues with their health when they get older, oftentimes. So they are more likely to have insurance than some of the young folks. And again, kind of reinforcing the statistic I showed you from the other study, about 40% of those that were under 65 were in a high deductible plan versus 25% in 2010. So this is the environment that your students will be graduating into. They're graduating into a world that by 2020, 4 of every 10 workers in this country are not going to have an employer. They're going to be working gig to gig freelancing, and increasingly they're going to have high deductible plans if they have any health insurance. So it's a new world. Staying on the Affordable Care Act for a minute, in 2016 we had the third phase-in of the penalties, except that not officially called the penalties. If you want to be politically correct, the IRS refers to the fee that people pay on their income tax when they don't have health insurance as the shared responsibility payment. So that's the term that they use. So if you see that somewhere, that's what they're referring to. But in a sense, it's a fee or a tax. It's extra money that people had to pay out of pocket because they don't have health insurance. So in 2016, it's a either or kind of thing, and it's the greater of the either or. It's either a flat amount. It can be $695 for adults, and then there's a maximum of $2,085 per household. And then the other one to look at is it 2.5% of your household income? And then they cap it at kind of a national average for health insurance. Quite honestly, I haven't seen too much about the figures for 2017. I think most of the news has been whether the Affordable Care Act is going to survive intact or not. So I haven't seen too many details about what it is going to cost people if they don't have health insurance. But supposedly it's going to be indexed for inflation, so those amounts will go up over time. How many of you talk about banking and overdrafts and those sorts of things in your classes? So just some current information about that. An article came out last year that said, and this was quoting research from the Consumer Financial Protection Bureau, or CFPB in Washington, that the typical overdraft fee now is $34 if you overdraft your account. And they found in their research that the majority of the overdrafts were happening on transactions of $24 or less. I see some shaking heads here, this corner here particularly. So what the CFPB did is they broke it down and said, okay, what is this as an APR, an annual percentage rate? And they said that if somebody borrowed $24 for 3 days and paid the overdraft fee of $34 on an annualized basis as an APR, it would be 17,000%. Wow, yeah, so that's a little statistic. Yeah, that is crazy. That is super crazy. I mean, you think payday loans are bad as an APR. You know, payday loans are usually somewhere in like 390%, or they get higher if you start rolling them over and everything. But yeah, big time. Okay, another thing that happened in the last year, of course, is the Wells Fargo scandal. Anybody have bank accounts at Wells Fargo? Okay. Well, Wells Fargo was fined $185 million, and you might have read that they created all these fake accounts, both bank accounts and credit card accounts. Why did they do this? Well, they had this culture in their organization that people had to create accounts. So if you couldn't get them one way, you created them another way. And so eventually what happened is they got rid of more than 5,000 employees. The CEO stepped down. What happened is some people were just getting unwanted cards. They were making up fake PIN numbers. Sometimes they were even doing transfers of money between people's accounts and then triggering fees and everything. So the big takeaway here is that people have to monitor their statements. They have to monitor their credit report to make sure that there aren't any credit cards opened in their name that aren't theirs. And then they also should be monitoring their bank statements. And as more and more people get away from traditional ways of banking and are doing it online, we just have to stop and remind people that it's fine to bank online. Go for it, but if you're not going to get a statement in the mail, if you're going to pull your own statement, you've got to come up with a system of when you're going to do your reconciliation, because reconciliation doesn't go away. That's a life skill. People need to still check their balance against the bank's balance. But if they want to pull their own statement and do that online, just make sure you do it regularly so you catch things. ACH upgrades. This is kind of an interesting thing. Anybody that might be doing freelance work, or even with paychecks now. And I've seen this even at Rutgers, a few of us that are from Rutgers now, that we now get expense reimbursements deposited right into our accounts. Where back in the day, we had to wait for checks way back in the day, and then we had a second stage where it was kind of put into our paychecks, and now it just goes right into our bank accounts. So we're seeing a lot of big changes in the way that the automated clearinghouse is basically electronic banking. It's the process that we have in the this country. So in September, they started doing what they call real-time money movements. And what that means for employers is that they can hold on to their money longer. You know, because back in the day, if you had to issue checks and everything, you had to move money a whole lot faster to be able to have, you know, certain days for checks to clear and deposits to register and all that kind of stuff. Now they can move money very quickly. So you may be seeing some changes in processes that way. Okay, here's a big one, especially for New Jersey. Somebody asked yesterday in our session, do I have New Jersey data? And sometimes I do, sometimes I don't, but I do for this one, and it's pretty eye-opening. Kind of goes back to some of the things Tim was saying before. So another first-time ever statistic is that for the first time in the modern era, so, you know, we're going back to 1800s here, folks. None of us were around back then. So for the first time since then, living with a parent is edging out all other living arrangements for 18 to 34-year-olds. And this is according to Pew Research. So I was talking with Dawn before. She's got that son at Rutgers who's going to be a boomerang child in another year or so, right? So yeah, it's happening. I talked to my students at Rutgers. They're all planning to come back and live with mom and dad. So nationally, just under a third, 32.1% of millennials are planning to, or are living at home, these 18 to 34-year-olds. In New Jersey, it's 49-something%. It's almost half. We have the highest, you know how we're so proud of all our statistics in New Jersey? We have the highest auto insurance rates, the highest property tax rates. Well, add this to the highest. We are the highest in percentage of all the states of young adults living at home with their parents. And again, a lot of people blame it just on the high cost of living. It's just very hard to launch yourself as a young adult in an area that's very expensive to live in. So that one activity that I passed out before, Tim really didn't take the time to talk about, we actually did it yesterday in North Jersey, was that living with roommates activity. And that's where you have 3 people that have to get together, you know, because they can't each individually afford to live on their own. So that activity is pretty great because it gives them the experience of negotiating. You know, there's 3 bedrooms, one's larger than the other. The 3 roommates have different income levels. How do you handle that thing? So we're going to see a lot of impact from that. And what the research is showing is that it's not just the young adults that are affected because they're kind of delaying home ownership and marriage and having children, that kind of stuff. But it's also impacting the parents' retirement savings. Tell you a true story. I was coming home on the train last year from the Financial Planning Association meeting in Baltimore. And I sat in the cafe car, and it turns out there were a bunch of CFPs from the meeting because we all knew each other because we were all carrying these Vanguard bands they had given us in the exhibit. So we got into an interesting conversation. One of the planners was saying that she had a client that is trying to leave New Jersey, wants to get out of here. They're ready to go, and they can't leave the state because they got kids in the basement, right? So the other planner said, yeah, I had a client like that too, but you know what they did? They sold the house senior year so they couldn't come back. So, I mean, you know, these are the kinds of stories. Yeah, they're a good story, right? So these are the kinds of issues that our families are dealing with. Yeah. Okay, another thing that's kind of current trend is credit scores. Because as you all well know, there is a law on the books that mandates that people can request a free credit report from each of the 3 credit bureaus, Experian, Equifax, and TransUnion once a year. But there is no law on the books about credit scores. However, what has happened is that in 2013, Discover was the first major issuer to put information about credit scores on their clients' statements. So my husband has a Discover card, and every time he has a Discover bill, it's a separate page in his statement, and it actually is nice because it shows 12 months, so you can actually see if there's a little bit of a change in the score, which is nice. It gives you a nice history, and they just provide that. So flash forward by 2016, most big banks were providing credit score information to their consumers. And they're doing it because they either want to use it to recruit consumers or to maintain consumers. So it's all about providing a value added to their customers. So it's estimated now that, what are we, like 320 million in this country, that an estimated 100 million people in America now have access to their credit score, one way or the other. Through a credit card, through a bank, they're able to access that information. So not surprisingly, at Rutgers, we have a WISE credit management quiz. It's one of our 6 quizzes on our website. And when we pulled the data to do some research a few years ago, we found that people had, were more likely to know their credit score, to have checked their credit score, than to have checked their credit report, which requires some proactive action. You have to either call a number or go on to the annualcreditreport.com website. You have to do something proactive. In this case, they're providing it right to you. And again, just remind people that having their information checked by themselves doesn't count against them. If you want to pull your own credit report, or somebody pulls your credit score just to report it to you, it's not going to count against you. Okay, tax fraud scams. So ask you, how many of you in the last month have had at least one, and maybe as many as 12 or 15 calls related to tax frauds? Raise your hand. I had 2 the other day, and I was like, really? So what's happening is there's an explosion of emails and calls that are purporting to come from the IRS. So what has happened, and I'll show this, the flip side on the next slide, is that you know how if there's a fraud going on and they close one door, what happens? They open another one, right? So that's exactly what's happened. So I'm going to talk about the door that they closed next, but this is the new door that they're using. So what they're doing is trying to confuse people in many cases. So some of them are tying it into that shared responsibility payment with the ACA that I talked about before. So they're confusing people and saying, no, you owe money for your health care, and it has to come on your income tax. And some of them are even brazenly telling people that they have to make a payment using a prepaid debit card. Like you have to go buy a prepaid debit card and then give them the codes for the card. Like, really? But that's the kind of fraud that's out there. So what you got to tell people is that the IRS very rarely will contact people by any other means than U.S. mail, especially initially. Maybe if you had a case going with them or something and you had a person you were working with. But if they're just going to call you for the first time, contact you, they're going to use regular U.S. mail. Okay, the flip side of that is why we're seeing a lot of those phone calls is that tax ID theft has really been cut down considerably. So a few years ago, you would have been correct in teaching your students that, oh, this is rampant and they can't get a handle on it and it's a really big problem. It's still a problem, but what has happened is 2 years ago, the IRS said, look, we got to do something about this. So they formed a coalition with all the state agencies and all the, like the TurboTaxes of the world. And they said, okay, we're all going to come together, we're going to share information, and we're going to try to cut down on this. So in the last year, they have really prevented millions of cases of fraud. So you can see on the slide there that the reported cases dropped by 50% during the first 9 months, and that was last year of 2016. And they were even predicting more safeguards this year. Now, the only flip side to this is that some people who had the earned income tax credit have had to wait longer, and that was reported. And yeah, people who are really living on the edge, that wait can be painful, but it's the only way that they can make sure, allow enough time that they can do the income verification to make sure they cut down on that. Anybody teach about index funds in your class when you teach about investing? Okay, so last year was a big event. It was the 40th birthday of the first index fund. An index fund is a mutual fund that follows a stock index like the S&P 500. So just a little history there. In 1976, Jack Bogle, who is revered by some as Sir Jack, and there's a whole legion of people called Bogleheads that follow him. He started the Vanguard 500 index fund with $11.3 million of assets. It's now over $3 trillion, and you've got all these Bogleheads out there that are kind of preaching the discipline of index investing. And then my last content chunk slide is on the FAFSA form. So yesterday we had somebody Samantha Benson, who is from the HESA, New Jersey Higher Education Student Assistance Authority. So she was talking about this firsthand from her experience too, that they have moved up the deadline for making application through the FAFSA for financial aid for college. So it used to be that you would have to file those forms in January, but most people didn't have their taxes done that early. So they were really kind of estimating their income. And now what they've done is they've moved it up to the prior October 1st, and then you can use actual income from the year before and not have to make it up because you don't know what it is yet. You haven't taken the time to get it all together. So what's happened, the implications of this, financial speaking, is that students need to get their FAFSA in earlier than before. They probably will get notification from the colleges earlier than before because, again, everything's kind of been moved up. And then from a financial planning standpoint, you know, if people are trying to minimize assets that might count against a child's qualification for financial aid, they'll have to go a year sooner if they're going to sell things like for capital gains or anything like that. Okay, so that's kind of a whirlwind of current trends that are out there. Any questions on anything I mentioned? Okay, so in this segment here, and we're going to go from, let's see, make sure we're back on schedule here. Well, not quite, but we're getting there. We're going to do there's 5 things listed, but we're going to do 3. There's one activity that I actually took from the lesson plan that I wrote, and I'll be talking more about those lesson plans later. What do I already know about health insurance? So I want you to pretend that you are your student, not your adult mind, but the mind of your student, and think about how a student would answer these questions. Because if you're trying to introduce the topic of health insurance, it's good to kind of find out what your students already know. So what personal experiences have you had as a health insurance consumer? So if you have kids, think about what your kids have experienced as health insurance consumers. What observations have you received about receiving health care services? What have you heard or read about health insurance? Now, certainly there's a lot in the news now with all the political discourse about the ACA. What television shows, movies, or advertisements relate to the topic of health insurance? Give you an example. In my class, when I try to teach about disability insurance, it's pretty foreign to students. And then all I have to say is one word. Anybody know what that word is? Aflac. Aflac. And immediately they know it's that bird, because that's what it's talking about. It's talking about disability insurance. And then what questions do you have? So take a few minutes to do that. And then move on, if you would, to health insurance math. And so I've given you a scenario there where there's a $500 deductible, 80-20 coinsurance, meaning you pay 20% and the insurance company pays 80%, and you have an out-of-pocket maximum of $5,000. So that's the most that you would have to pay through a combination of deductible, co-payments, and coinsurance. But we don't have any co-payments in this example. It's just coinsurance. So the first question is going to ask you, you have $7,500 worth of expenses. How much do you have to pay out of pocket? And then the next question is, you have $20,000 worth of expenses. And then the third question is $40,000 worth of expenses. And then if you have time, the last thing that you might want to look at in this segment is pros and cons of living at home with your parents. So again, if this is a big problem, particularly in New Jersey, this is an activity that I had in one of my lesson plans too for the state, is you would have what are the advantages to the parents, disadvantages to the parents, and then for the young adult, advantages and disadvantages. So I'll give you about 20 minutes or so to kind of go through some of these activities together.